Mexico and Canada get a 1-month reprieve from Donald Trump's 25% across-the-board tariffs, and China is in talks for a similar reprieve. China's response was also limited yesterday, which markets welcomed overnight, and New Zealand's unemployment rate is expected to rise over 5% in data due later today. That's coming up in our 5 Things in 5 Minutes on Wednesday, February the 5th. And then, in today's bonus deep dive interview, ANZ's economist Henry Russell says ANZ's Business Outlook survey indicates New Zealand's economy turned a corner at the end of 2024.
We have an additional 25 basis point cut forecast for April, but the Reserve Bank is likely to be more cautious as it reduces interest rates moving forward and approaches a more neutral policy setting.
But first, in 5 and 5 with ANZ, China has announced limited tariffs on various US products and an antitrust investigation into tech giant Google in relation to the 10% tariffs being placed on its exports to the United States. The move follows a reprieve for both Canada and Mexico. ANZ economist Bansi Madhavani says from London overnight the limited nature of China's response helped markets recover somewhat.
Look, in terms of China's response, it was swift, but it appears more targeted. China's tariffs target imports worth around $14 billion from the US. This compares to a blanket tariff by the US on all Chinese goods. President Trump said that he will speak with President Xi, and that keeps hopes alive that we could see some sort of deferral of tariffs while negotiations continue in the background. Peter Navarro, who is President Trump's senior trade advisor, said that the US-China call on tariffs will take place. So the question now is whether the US and China can reach an agreement before Chinese tariffs kick in on the 10th of February.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 0.9%. The S&P 500 was up 0.6%. The US 10-year yield was down 3 basis points at 4.53%. And in the local currencies, the Aussie dollar was up 0.5% at 62.53 US cents, and the Kiwi was up 0.3% at 56.46. Number 2. ANZ Research and the Reserve Bank of New Zealand expect New Zealand's unemployment rate rose from 4.8% to 5.1% in the December quarter, with jobs falling by 0.2% to 0.3%. ANZ economist Henry Russell says there would have to be a large surprise to throw the Reserve Bank off course from a 50 basis point cut in 2 weeks' time.
What's going to be more important in these data is not what it tells us about the February meeting, but what it means for the path of interest rates moving forward. While we are seeing a recovery in the economy, the labour market does tend to lag the broader economic cycle, but nonetheless, the Reserve Bank will like to see a stabilisation in the labour market in the near term, given that there is already sufficient spare capacity in the labour market to return inflation near the 2% target midpoint.
Number 3. New Zealand building consents dipped by a seasonally adjusted 5.6% in December from November due to volatility in multi-unit projects. Annual consents were down 9.8% from 2023. Henry says the downturn does look to be stabilising though.
On an annual basis, the downturn in consents does look to be stabilising overall, but given the significant expansion in population over the past few years at the hands of record migration inflows, we do need to see a lift in consents moving forward in order to continue the supply of new housing into the market and to prevent excessive relative house price gains moving forward.
Number 4. ANZ Roy Morgan's Australian Consumer Confidence Survey showed a rise of 2.5 points last week to 88.5. ANZ economist Sophia Angala says that's a 32-month high.
Looking to the sub-indices, households are feeling more confident about the economic outlook, with short-term economic confidence rising to its highest levels since April 2022, which is before we saw that first RBA rate hike in May 2022, while economic confidence over the next 5 years reached a 12-month high. The time to buy a major household item sub-index also jumped just over 5 points.
Number 5. Sophia says inflation expectations in Australia dropped from 5.2% a couple of weeks ago to 4.6% in the latest survey.
That fall in weekly inflation expectations and the broad-based lift across the sub-indices may have been influenced by coverage that the RBA could cut rates at its February meeting. This comes after last week's Q4 inflation data showed that the RBA's preferred measure of inflation, the trimmed mean, printed at 3.2% year-on-year, which is below the RBA's forecast of 3.4% year-on-year, and which we think will be enough for the RBA to cut the cash rate by 25 basis points at its February meeting.
Sophia Angala there. Now, in today's deep dive interview, we go back to ANZ economist Henry Russell, who talked with my colleague Alex Tarrant about the state of New Zealand's economy through a business lens, following last week's ANZ Business Outlook survey for December, which saw confidence remain high, although dipping slightly.
What we are seeing in terms of the most upbeat sectors is that's across retail, manufacturing and construction. But it's important to remember that these were the sectors that were hit hardest, the slowdown over the past few years. So while they are feeling more upbeat, that's coming off a weaker base.
I see employment intentions remained steady, plus the cost expectations and wage expectations shifting up a bit. Does that give any sort of hint of concern in terms of what the Reserve Bank might be thinking?
Certainly the lift we've seen in pricing intentions, which has actually gone up in 6 of the past 7 months, and also cost expectations, which remain very elevated, they will be somewhat of a concern to the Reserve Bank. But importantly, tempering that will be a reassuring CPI print we saw for the Q4 that was released earlier in the month. Look, it certainly speaks to a still very high cost environment for businesses, and that may speak to still some lingering supply side constraints in the economy. And the risk here is that if we do see a vigorous recovery in demand, that gives firms the chance to rebuild their margins and start to increase their prices. But where the level of demand is now, that appears to be stifling those intentions to raise prices. And so in the near term, the consequences for inflation look to be limited. But what this speaks to is probably some risks further out into the horizon later at 2025, where as the economy rebounds, it remains an open question just how much growth will be able to be delivered before inflation pressures renew. That shouldn't stand in the way of the Reserve Bank delivering another 50 basis point cut when it meets next month, and we have an additional 25 basis point cut forecast for April. But the Reserve Bank is likely to be more cautious as it reduces interest rates moving forward and approaches a more neutral policy setting, and that is really related to this potential supply side disruption still lingering in the economy.
Export intentions dipped a little bit in the month, but that's against the backdrop of the New Zealand dollar dropping quite a lot recently, especially since Trump's election. Why do you think that lower New Zealand dollar is not really feeding through to export intentions rising?
A weaker New Zealand dollar is certainly going to be helpful for export returns, but whether or not it will lead to an increase in volumes is another story. If you think about some of our largest sectors for exports, agriculture and primary products being one of those and the biggest, those industries do face environmental and land use constraints that somewhat prevent or limit the extent to which they can expand volumes, and even if a weaker New Zealand dollar increases their price competitiveness. So certainly we'll expect to see the lower exchange rate play out in the price for goods we receive in New Zealand dollars, but potentially it won't lead to as significant a pickup on the volume side.
And then this is the first snapshot of the economy this year. You've been saying in your notes that you think the turnaround has happened or is occurring. Is there anything in this to verify or go against how you're thinking the economy will perform over 2025?
So if you look at the past activity and past employment questions in this survey, these tend to be, particularly the past activity question, that is the best indicator of GDP in the survey, and that sustained its bounce that it saw in December and in fact across Q4, and it's actually returned just into positive territory, and that does speak to a recovery in the economy that is underway, and we do expect a return to growth in Q4. On the employment side of things, that was also a more positive element of this survey, with the past employment question showing another lift. It does remain in contractionary territory still, but what this survey suggests is that the pace of contraction is easing. Labour market conditions do tend to lag the broader economic cycle, and so while the downtrend in employment that has been in place for some time does probably have a little further to run, it is reassuring to see that is now starting to slow, and that does pave the way for a stabilisation in the labour market around the middle of this year.
Henry Russell there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, February the 5th. Catch you tomorrow with what New Zealand's jobs data could mean for the Reserve Bank of New Zealand. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.